It's great to be here with all of you today. I appreciate the opportunity to be up here in front of you. As Cindy mentioned, the purpose of this panel is to talk about internal control, ICFR, and it's obviously an area that's been a challenge, and we thought we'd get up and talk a little bit about some of the practical realities of auditing ICFR, as well as some great academic research that's been done. So before we start, maybe I'll introduce who's up on the panel here. To my right is Mark Panucci. Mark's a partner in PwC's national office. He's also a member of the AICPA Auditing Standards Board. He worked in the U.S. Securities Exchange Commission for several years as a senior chief accountant. And you've got everybody's bios, I think, in your book, so I won't go into too much detail. To Mark's right is Rick Elchi. Rick's the managing partner of the U.S. Audit Services for Crowe Horwath. He currently serves as a member of their executive board, which is the equivalent of their board of directors. He's been a panelist at numerous roundtables hosted by both the SEC and the PCAOB, and we're delighted to have him here with us. And then to his right is Susan Schultz. Susan is the professor and a Harper faculty fellow at the University of Kansas. Her research focuses on issues involving restatements and auditor choice. Her work has appeared in a variety of accounting journals and been commissioned by the U.S. Department of Treasury and the Center for Audit Quality. And to Susan's right is Greg Trompeter. Greg is the C.G. Avery Professor of Accounting at the University of Central Florida. Prior to arriving at UCF, he had served in the accounting faculties of my alma mater, Boston College, which I have my oldest daughter starting at Boston College next month, so Greg may get the softball questions today. And he's also been at the University of Notre Dame. His research focuses on internal controls and fraud, as well as issues related to auditor independence, regulation, and economics of the auditing profession. So similar to the last panel, we'll have a little bit of a discussion back and forth, and then at the end we'll cut off in time to take some of your questions. So with that, I guess I'll just start with asking the group. Obviously internal control we've been doing for a long time, but we continue to be challenged. So maybe I'll just start with Rick and Mark. Why do we seem to struggle so much auditing internal control?
Well, I mean, I think when you look at it, and you said we have been doing it for a long time, and it's been 10 years, but there have been two auditing standards with it. And yes, I think when people first thought about ICFR, they said, well, the auditor's thinking about controls in the financial statement audit. How significant will it be? But it really was a big change, right? Because it's a different mindset. You're really thinking about it in terms of, do the controls on a standalone basis, would they detect a material misstatement? And that is a different mindset than thinking about controls and just planning the audit. And so with that, I think people know the history, right? When you get through the AS2, there was a lot of complaints from all parties that, did this go overboard? And did we have inefficient audits? And you move that then to AS5, and there was sort of the top-down approach that everyone talked about. And I think the profession, in hindsight, as we think about it today, did we misinterpret or swing that pendulum too much to the right when we think about that top-down approach? Probably. And I think we're seeing it through internal and external inspections both. We're seeing that balance come back, I think, again. And again, having the right mind frame of we want to have an effective and efficient audit and keep that objective in mind that, do the controls at a standalone, would they detect a material misstatement? So we are seeing the challenges. We got, I think, ways to improve still on it. But I have seen improvements over the last year or two, and hopefully we'll continue to build on that.
I might add that I think that from the perspective of our firm, which primarily works with middle market issuers in the public space, the issue has really been, or the biggest challenge has been around things that are not repetitive. We find that in financial statement auditing, many things are very easily validated. Often numbers are easy to compare to third-party evidence. Even accounting estimates, generally speaking, you can find the methodology used to arrive at the estimate. Internal control is different. Sometimes audit evidence is very difficult to locate to determine how did a control operate. And so, one, I think the audit evidence issue is one that's challenging for us in the profession. And I also think the controls around the infrequent transaction are also very challenging. If you look, when we hear about the restatement research, when you think about what's happened in the restatements, very often the restatements come about because of a large transaction that was not handled correctly. You might find a contractual clause that wasn't interpreted appropriately or even caught by the accounting department. And it's very difficult when you're an auditor looking at control processes to understand what is it within the minds of the accounting people that causes them to read the words in the paragraph and not understand that there might be accounting implications. And that's a very real issue. I'll give an example. Today, it's not uncommon at all for a public company to seek some type of incremental financing from a private equity firm. And if you look at the contracts for financing instruments from a private equity firm, it's very difficult to say this is a bond or this is a stock. What you have is a very complicated instrument, and many times a company with a very high-powered accounting staff may not have run across many of the terms in those kind of agreements and understand the accounting implications. So that drives to competency, and competency in my mind is again, one of the very difficult issues for us to deal with. So I feel pretty good about where we've evolved to on controls around the identifiable, the concrete. I think we still have a long way to go as a profession to understand how to think about and test for controls around the infrequent and the judgmental and the prospective transaction that's going to come down the road where we know our clients don't have experience.
Great. Some great perspectives. Now, let's look at some statistics. So, Susan, I know this has come out of your research. So this is a chart on trends in adverse opinions under ICFR. Susan, maybe a little perspective, provide an overview of some of your research and what this chart's telling you.
Sure. I really can't take credit for this particular chart. This comes from Audit Analytics, but it is using some of the data that I drew on. So what we're looking at here is just the total number of ICRF reports that are issued by year of reporting. So the first year would have been, for the 2004 year end. Then we see the number of those that noted an adverse opinion, and then just the percentage. And it starts in year 4 in the second set of columns, because that's when the smaller companies that do not have the auditor report as well as management reports start to issue their internal control reports. So a couple of things to note here that really jump out at me are that the companies that do not have the auditor involved in their reporting report just baseline a much higher percentage of weaknesses than do those that have the auditor involved. Now, when you start putting some expectations and using some statistical analysis, it turns out that the companies with the auditor involved are much, much more likely to report an internal control weakness before restatement than are the companies that only have management. So it seems like there's a closer tie to actually finding a problem when the auditor is involved. But the baselines are very different. And I think there's some interesting ideas some of the people have here about why that's going on.
Mark, Rick, any perspective on what appears somewhat counterintuitive?
Well, one might say that the companies that don't have the auditor's help are doing a lot better job identifying weaknesses. I suspect that's not what's really happening in place. I've yet to have an audit team tell me that their client came to them with a draft of a 10Q that said, here's the material weakness we're going to report this quarter. We found it, here it is. And the reality typically is more like, here's a problem, and the company may or may not have thought about the fact there's a control implication. And many of those, again, your mid-market kind of filers very often may not have even made that leap. Does this mean I have a control problem? And of course, the auditor subtly suggests they should think about that. And I think in many, many cases, if it wasn't for the auditors' behind-the-scene involvement, you would not have seen these control weaknesses find themselves at the public filings. And generally speaking, in my view, this data is simply a resource issue. The smaller companies put fewer resources in two critical areas. One is the actual accounting staff itself, so not the control, but the actual people who are handling the transactions, evaluating the transactions, and recording the transactions. And then second, and so they don't get it right out of the box as often as the larger companies. And then secondarily, the same resource issues seem to be in play around the review process and the control process. So I think it tends to be, in my mind, an issue of resource application rather than an issue of the fact that somehow we take away from value when the auditor is involved in the process.
Yeah, and I would agree with what Rick said. I mean, you know, the auditor's still going to have to communicate the material weaknesses, so it's really hard to say how many of these are really auditor identified versus management identified. But you know, I also agree sometimes, you know, smaller companies just might have segregation of duty challenges, and they say, you know, from their investor group and their perspective, they think there might not be much of a market reaction, and they say, instead of spending the resources, I'll just report the material weakness, or it might come up late so they don't think about the remediation of it. And you know, there could be a lot of other reasons. You also get to they're just smaller, so the materiality level's smaller, and if they're not making those investments, you know, by definition, it might be easier for them to say it's reasonably possible the financial statements could be materially misstated. So I think all those get into it, and it seems like, you know, an area maybe that just got to continue to be explored, because you probably need to understand sort of each one of the material weaknesses that are underlying some of the data.
Right, so the sense is that the smaller companies have weaker finance staff, so most of these are probably identified through the audit. What about the idea that larger companies have stronger systems of control, so therefore they're remediating during the year? So a lot of times the issues get remediated. Can maybe comment on that a little bit, that these are getting caught and fixed, whereas in the smaller companies it's a more substantive approach. Maybe at the end of the year, these issues being identified and it's too late to remediate, right?
Yeah, and I think that is true, because you have the larger companies are going to have the discipline of not only having the management assessment, but you need the audit, right? And so that process is occurring throughout the period, throughout the year. It very well might be identified, whether it's a material weakness or not. Could be a significant deficiency, and those things are being remediated before you get to the year end. And obviously, if it's, you know, remediated by year end with the opinion of an as-of date, you still see a clean ICFR opinion.
Good. All right, now we'll look at some more of, actually we'll now move to Greg. So we haven't given you a chance yet to talk yet. But Greg, you and your colleagues have recently done some other research. I think you did some research if you took 20 practitioners and gave them kind of a case study and asked them whether they'd identify this case study as a material weakness or not. Let's tell us what you found.
Yeah, actually, to sort of characterize it, I would say these are just damn tough issues. In part, I think it's because as accountants and auditors, we naturally gravitate towards that which is quantifiable. And a lot of times with these internal control problems, we're looking at qualitative issues and trying to attach numbers to them. So as a bit of background, as Frank said, we had hour-long interviews with 20 audit partners. And to tee these up, what we did is we sent out a couple of cases to each partner in advance. Each case described a hypothetical audit client that had some material weaknesses. We conduct the interviews. We finished up our last interviews in June. I've spent most of the summer pulling together creating big data files so that we can do in-depth analyses. We've just started doing the analyses in the last couple of weeks, but I think I can offer some preliminary observations. First off, when we talk to people about are these problems in the case deficiencies, or do they rise to the level of a significant deficiency or perhaps a material weakness? Not surprisingly, everyone gravitates towards magnitude. How do I get a handle on materiality? And then some of the issues that come up in talking about materiality, a lot of our participants they go to extrapolation. And this is difficult. For example, in one case, we had the hypothetical was a broker-dealer, decentralized, 75 offices around the country. The auditor examines about a third of those offices and finds a problem with 3 of them. So I've looked at a third, I find 3 problems, can I extrapolate? And for the most part, it's not terribly quantitative, and so the partners weren't comfortable with that. More likely, they go towards, can I put a fence around the problem, right? Can I isolate it, squeeze it down? Maybe I find that there's a common factor that all 3 of the problem offices, they're in the Northeast. So maybe I rescope part of the audit because I'm trying to figure out what's my exposure here. I re-scope to focus more exclusively and more in depth in the Northeast. But again, I'm still stuck with having to try to come up with a quantitative measure of the qualitative. So to be a little more specific, in this problem, these 3 offices, the difficulty they had was in 2013, the SEC had a new requirement for broker-dealers to have additional communication between the broker-dealer and a certain class of their, subclass of their clients. And for these 3 offices scattered around the country, that communication wasn't happening. It hadn't been built into the system. And so some partners gravitating towards that quantitative notion, like, okay, so we've got a problem. We have clients that, we have a client where the offices have violated securities regulation. There's going to be fines. There's going to be penalties. How do I come up with an answer for that? And that part's really easy, right? It's like that part's the quantitative. But the qualitative, if you dig a little deeper, is I've got offices that in a decentralized organization where corporate policy, or in this case, federal regulation, isn't being incorporated into the system. So the least of my concerns might be fines and penalties. What I may need to be thinking about is, are there other corporate policies that aren't being implemented on a timely basis? Are there other federal laws that are being violated and we don't know about it? So it's easy to do this scope where it's fines and penalties. I multiply it times the number of offices. What's much more difficult is digging down below that and looking into those more qualitative control problems. How do I put a number on, oh yeah, my client might be in violation of an unknown number of federal laws. Sort of difficult to attach a number to that. So I'd say it's easy to gravitate towards the quantitative, but very difficult to deal with those qualitative issues.
I remember when we were talking about it, what struck me was you said that everybody kind of gave you a different answer, right? Some concluded, some couldn't conclude, but most said just need more information. It's a matter of judgment, right? So
yeah, I would say out of 20 partners, each of them had, among the cases, there were 4 or 5 different decisions to make. So say there's 80 possible decisions they could have made. We only got a definitive answer in these cases on maybe a dozen of them. Wow. Most of them, the cases were designed to elicit good discussion about what factors do you consider in determining these. So for the most part, discussion just focused on, yeah, these are some of the things I think about, but I'd have to have more information to be able to actually nail this down. And even if I had more information, it's still a difficult judgment to make.
Right, right. Good. Now, as you did that research, you also sat down and said, all right, now if you've drawn your conclusion, or you're not sure, how do you discuss these with management? What's the process? And tell us a little bit about what you heard from some of these teams.
It all started off as very uniform. Everybody said, the structure of that conversation is really simple. We start with the authoritative literature. We walk the client through our audit work and our audit findings. And done. However, the next statement is, but usually, actually I haven't looked at the data, it might be universally, there's going to be pushback. And then the discussion kind of moved into what kind of pushback do you get, right? So different reasons, management reasons. One might be it's a one-time event. It's only a one-time event. A lot of partners suggested that they hear that regularly, to which their response is, okay, so maybe I don't understand your control system as well as I thought. Prove it to me. Prove that it's a one-time event. Or In one of the cases, the source of the problem was it's a new guy. And now he's been trained, so now the problem doesn't exist. and uniformly, universally, every partner that I can think of came back and said, yeah, that's not the problem. The problem is your internal controls aren't sufficiently robust to handle onboarding of new people. That's a much bigger problem than the new guy made a mistake. Then you get into like some of the other explanations where internal audit would have caught it, in which case some people said, well, my first question then is why didn't they? But yet a more fundamental level is internal audit shouldn't really be part of your internal control system. They should not be a key control factor. And if they are, then we need to rethink the independence of internal audit, which brings in a whole raft of other complications. But I think ultimately, the biggest problem was always, it always came back to entity level controls. How do I determine if they are sufficiently refined or sufficiently, I guess, granular, being the term that's used, to detect these problems? Then the discussion came back to 2 final points. One was, I want management on my side when we go to the board, because management ultimately is going to be responsible for remediation. But at the end of the day, I don't negotiate with management. It's my opinion. And if management disagrees, yeah, well, then we agree to disagree, but it's my opinion at the end of the day. So the discussion starts off very amicably and very standard, but then it can go in one of a million different directions depending on the facts and circumstances.
Frank?
Mark and Rick sound like reality?
It's very real. And there's some really interesting dynamics. Just a couple points I'd like to make. I think that it's hard to get to these and get the real world answer out of a case study here, because the absolute most important element in terms of trying to evaluate the severity of a deficiency that's been identified is to get to the why. You need to know why it happened. And that's really what an awful lot of the tug of war between the auditor and the company is about, is why did it happen? And the why is either going to take you toward a path that you can identify some very specific items and you can deal with those items, or the why is not going to take you there, which probably means there's a design flaw in the controls, and in that case you typically have a very major issue from a magnitude standpoint. So I think if you are extrapolating error, you're probably got a real big problem. If you can't find and you don't extrapolate typically when you have a why, or you're doing it over a much smaller area. I also think there's an interesting dynamic that hopefully time will cure, but we made the observation early on that we've only been doing this about 10 years, and you go, well, that's a decade, isn't that long enough? Well, it's long enough for the profession, and the profession, I think we're getting fairly mature around this issue, but the issuer companies are still full of financial people who have never, ever, ever had to audit, or they were not in a public accounting firm when you were auditing internal controls. They may not be in charge of the control processes in their company. Often a 404 team was put in place, or internal audit handles that. So the control dialogue is often, there's a very significant imbalance, I think, between the audit firm and the financial reporting staff. Sometimes, again, we see this in the middle market companies a lot, because those financial people simply did not grow up with controls as part of their vernacular. Time's going to solve that. As people make that move now, that's going to get solved. But that's still an element of, we have to show them the literature sometimes, help them understand the basic concepts when you're evaluating deficiencies, because they just never had to do that.
That's a great perspective.
Yeah, and so I think when I was hearing Greg speak and listening about it, I started thinking, well, this is every consultation I go with on engagement teams, right? This is exactly how it starts, right? It's, normally you get the phone call and it's, well, we have an error, a decision was made, it's not material, and the company thinks that from a control perspective, the magnitude's capped at the actual error. So we're done, right? It's not a material weakness, or at least that's the company's position, they're done. And you get into, well, exactly what Rick is saying and what Greg's saying. It's, well, before we start that process, we got to know what failed, right? And a lot of times, these things might accumulate over time. And so you're almost getting back into hindsight of what was the breakdown. And so, Rick was talking earlier about non-recurring unique transactions, right? And so you sit there and say, okay, if that went wrong, what are some other transactions that are similar to it? And, let's say, well, they got them right. Well, okay, that's a good starting point. But again, do they have the controls in the process to make sure you got it right, and not just that they got it right? There's other ones that are even more simple, right? There's times where you could have like a goodwill annual impairment test, and auditor identifies an error in an input, right? And so it significantly reduces the headroom, so they still pass kind of step one. And so they call and they start consulting. You say, well, what was it? What was the root cause? It very well could be there's something unique about that input. Maybe it's around the taxes, and that's the only input the tax department has their hands in. It could be something that had to be pushed down to a reporting unit. So you very well could say, okay, well, maybe the rest of the inputs, again, if you can demonstrate the controls work, it's isolated to that one, and very well could be it's not material. Or the other side, if you keep doing the root cause, because they'll start with the one-time event is something I think I see in almost every memo, the first draft from a company, right? If you really get to the root cause around it, you might find out, well, there's a design issue and there's not a review of any of the inputs. Well, now there could be multiple inputs that went wrong that could have caused them to fail step one, and the controls would have never detected. And now you're getting into a broader magnitude discussion.
Great perspective, and I could bring it to life, how hard these things are. If you're running the kitchen here, and the dish that dropped in the background, is it a deficiency, significant deficiency,
Right.
material weakness, right? All right.